Welcome to The Explainer. Today, we're diving into the story of Oxbridge Re. Now, this is a small reinsurance company that's in a really fascinating, high-stakes fight, a battle between its own disastrous present and a super-ambitious, high-tech future. All right, let's get into it.
So, I want to start with just this one number, 621%. Now, this is not a stock gain, believe me. It's a key number from Oxbridge Re's latest financial report. And you know what? It signals a massive, massive problem. And it makes you ask one thing.
I mean, seriously, how is that even possible? How can a company's losses and all its expenses be more than 6 times the money it brings in? Well, that's exactly what we're going to unpack in this explainer. We're going to get into the story behind this absolutely staggering figure and what in the world the company is trying to do about it.
Okay, so to really understand what's going on here, we have to start by looking at the hard numbers from the company's second quarter of 2025. And, to put it mildly, they were bad.
Just look at this disconnect. Wall Street was expecting a tiny profit, maybe 3 cents a share. Instead, the company reported a loss of 25 cents. And revenue? Not even in the same ballpark as the estimate. This wasn't just a miss. This was a total shocker that caught the market completely by surprise.
So what caused this financial train wreck? Well, the answer is right there in the company's core business model. See, Oxbridge specializes in what's called low-frequency, high-severity risk. In plain English, they cover disasters that don't happen very often, but when they do, boy, are they catastrophic. And in Q2, a catastrophe hit.
And this right here brings us all the way back to that 621% number. The official name for this is the combined ratio. It's pretty simple. For every dollar an insurer earns in premiums, this ratio tells you how much they paid out in losses and expenses. So anything over 100% means you're losing money. A ratio of 621%, well, that means for every single dollar they collected, they paid out $6.21. It's an absolutely brutal, unsustainable figure.
The culprit, it was a single event, Hurricane Milton. This one storm triggered what's called a full limit loss on one of their big contracts, forcing them to pay out the absolute maximum amount, almost $2.3 million. For a company this size, a single hit like that is just devastating.
And you can see the direct hit to their own books right here. Even after they shared some of that loss with outside investors, Oxbridge's own equity took a $1.18 million blow. That is the real, tangible cost of one bad storm.
But okay, this is where the story takes a really wild turn. Because while this hurricane was raging through their traditional business, management was placing a massive, massive bet on a completely different future, Web3. The story pivots right here from disaster to some pretty daring ambition.
The CEO himself, Jay Madu, he made it crystal clear. He said they're not just, dipping their toes in the water. They are solidly entrenched. They see their entire future in these tokenized securities based on real-world assets. This is a radical bet the company kind of shift.
So what in the world are these RWAs they keep talking about? The concept is actually pretty simple. You take a real-world thing that has value, in this case, a reinsurance contract, and you create a digital version of it, a token, that lives on a blockchain. This lets investors buy and sell little pieces of these contracts, opening up a whole new way to invest.
And they are not messing around. Through their new subsidiary, Surens Plus, they're offering products with some pretty eye-popping target returns. A balanced product aiming for a 20% annual return and then a high-yield one targeting a wild 42%. I mean, the contrast between these ambitious future numbers and the massive losses they're dealing with right now, it couldn't be more stark. And look, this isn't just some idea on a whiteboard. They're making moves. They've built the Surens Plus subsidiary, and they're teaming up with major players in the blockchain world, like the Midnight Foundation, which is tied to the founders of Cardano. They are actively building the plumbing for this whole new venture.
So you've got this wild situation where the company's house is basically on fire, but at the same time, they're showing everyone the blueprints for this futuristic skyscraper they're going to build right next door. So what do the people with the money, the investors, think about all this?
Well, the market's verdict has been pretty harsh. Over the past year, while the rest of the market and even the insurance sector were doing just fine, Oxbridge's stock plummeted by over 33%. So clearly, despite all the exciting Web3 talk, investors are punishing them for the failures in their day-to-day business.
And this right here gets to the heart of the whole conflict. You listen to management, and their story is all about the future, about tokenization, about these cool new partnerships. But you look at the stock price, and it tells you investors are still laser-focused on the past, that hurricane, those massive losses, and the risk that the company might just run out of cash.
So what you have now is a company fighting a war on two fronts. It has to somehow manage the crazy ups and downs of its current business, while at the exact same time trying to fund and build an entirely new one from scratch.
This really lays it all out, doesn't it? It's the whole dilemma in a nutshell. On one side, you have the present crisis, a 62.1% combined ratio and a stock that's in free fall. And on the other, you have the future bet, the promise of 42% returns and big-name crypto partnerships. Oxbridge is literally living in these two separate realities at the exact same time. And that really leaves us with the final, critical question. Oxbridge is in a race against time. They're betting everything that they can build this innovative, high-tech future before the next high-severity event from their old business model completely wipes them out. So can their future arrive before the next hurricane does?